I want to share with you two different studies that go together that we did in Mexico. And they both try to get at important questions that are fairly controversial in the microcredit space. The first is what the sensitivity is to interest rates. Now, it might sound like a very dorky question, but we all know that the interest rate policy around the world is very controversial. And for many years, a lot of funders and investors and policymakers were pushing microlenders to raise their interest rates up to the point of sustainability. Basically, the summary of the argument usually consisted of something like, well, the outside option or moneylender debt, that's really much more expensive, so whether you're charging it 50 or 80 or 100%, you're still better than moneylender debt. And so you need to figure out the point at which you can expand the best and bring the most credit to people, and you can feel confident that anything you're doing is better than moneylender debt, so people are happy to be getting that credit rather than more expensive moneylender debt. So this basically imagines a world that is fairly inelastic, and so in terms of their demand for credit. This is a striking. This is one of those questions that is full of rhetoric and full of debate, and was thoroughly lacking in really strong data. And we had done an initial study in South Africa that used direct marketing, the same way that many consumer finance companies in America, for instance, I don't think this is common in Peru yet, I suspect not, but every day when I come home from work, I have a couple direct marketing offers from credit card companies. And this is standard business, is to be running randomized trials for business purposes, not for research, for internal business operations to maximize profits and figure out exactly how sensitive people are. And with that, they test lots of other things too. So we took this approach to this firm in South Africa, and we found that there was some sensitivity to interest rates, but that it wasn't super steep in the short run, but it was just a short run study. And we were talking with CGAP and World Bank, and they were very excited by these results and recognizing the need for this type of data. So we worked with them to identify where are some other markets where we could do this study in the longer run, and where the question is really very pertinent for public policy purposes. And so they introduced us to Compartamos in 2006, and we embarked on this study with Compartamos, which I'm going to explain, in which we measured the sensitivity to interest rates in their market. The short punchline then, in case anybody leaves early, is we found strikingly sensitive, strikingly large sensitivities. In fact, so much so that lowering the interest rate by 10 percentage points for them over a 3-year time horizon brought in so many more clients, and also kept the clients they had and increased the loans that people were taking out by so much that it overcompensated for the loss in revenue from lowering your interest rate, and net revenues went up by a lot. Now, it's also the case that they weren't at a point operationally where they could expand without incurring larger costs. So the labor cost of servicing more clients was the same as the increase in revenue. So at the end of the day, it was profit neutral to lower the interest rates. Now, this is going to segue, though. So you might say, as a policy person, okay, lower rates, are these good or bad for people? So this might sound like a silly question to pose that way, but we see a huge debate in this world about whether people take on too much debt, over-indebtedness. So if people are really sensitive to interest rates, it very well may be if someone is a consumer protectionist trying to think about regulations to put in place to protect individuals, that they don't want to see lower interest rates if people are really sensitive. They want to see fewer people taking out loans that if they don't think they can handle them, and they think people are getting over indebted because they're taking on credit they shouldn't be taking. They might actually argue that seeing Compartamos expand access to credit by getting more people in the door by just making a fairly small but important change in interest rates is actually a bad thing. On the other hand, obviously, the argument that says no, giving people more choices in life and expanding their access to credit expands their choices is a good thing. And so this is great. This is a win-win. This is the heart of what we mean by a double bottom line firm, a micro lender making money, making profits, and improving people's lives. So one obvious point, though, is that the world's not so simple. Right? So the answer could be yes to both of these things, and it could be that there's some pockets of people who are made better off and some people who are made worse off. And so the challenge we really face is not, it's good to have a kind of an average answer, and that's good. It's better than not having even that. But what would be even better is having some guidance to say, look, these are the pockets of people for which you're making them better off, and these are the pockets of people that are making them worse off. And what's great is if we can actually identify who those people are. And then double bottom line firms can do one of two things. They can focus on the people who they're making better off and not the people who are not. Or they can change what they're doing for the people who are not being made better off in a way to help figure out how can we improve what we're doing to make it better for them. And so that's basically what we've embarked on with Compartamos was a very large randomized trial measuring their impact with a strong focus on trying to understand not just the average impacts, but whether there's pockets that are made better off and pockets that are made worse off. Okay, so that's the overview. Now let me go through and explain what we've done in a little more detail. How long do I have, by the way, in total? 20 minutes total. Okay, and I've used 13 minutes left. Thank you. Can I get some water? So yesterday, I'm going to state again the impact question because it's really important and near and dear to all the research you're seeing. How did people's lives change? We kind of think about that as the before-after. Compared to what would have happened without the program, and that's the counterfactual. And the whole point of doing randomized trials is trying to understand that second part of that question. The first part is kind of the easy part. Measurement is also sometimes hard, right, figuring out how to measure things accurately, but to some extent that first part is more logistical and brute force. The second is the one that requires more advanced thinking in terms of how do you figure out what would have happened. And that's the whole point of the randomized trial. Now, in the case of microcredit, the reasons for running randomized trials are hopefully should just be jumping right out at you. What else is happening in the economy to change people's lives? If you just followed people before and after a study, before or after they got access to a loan, how do you know whether the loan made their lives change or whether there was just good economic times or bad economic times? Right? Suppose that everybody did worse over time from getting access to credit. After getting access to credit. But if there was a really bad economy, that was from the economy, not from the credit. So you can't just look at before after. It really tells you almost absolutely nothing. The second set of issues have to do with why do some people join a program and others not? Suppose that people do horribly after getting access to credit. Absolutely horrible. You give people a loan and then they do, some people do absolutely horribly. How do you know that the credit wasn't the thing that they latched onto in that moment of despair to absorb a shock? And yet it wasn't good enough for everybody, right? So it helped some, but not everybody. And so on average, you see a lot of people do worse off, but in fact, that's a story that I just told you in which the loan actually helped some people, and the ones who were worse off because they used a loan in the moment of dire need, right? So, the fact that some join a program and others not is a choice that we make, and that makes it very difficult to construct that counterfactual. You need to have some people who not just didn't choose to take out a loan, but didn't choose to take out a loan for some reason that was basically random so that we can compare. Similarly, lenders choose where to go. Right? So it's not always about the individual choice that creates the need for the randomized trial for these questions. It's also, I'm a lender. I choose to go into areas that have what I think are going to be thriving markets so that my clients will do well, and I don't go over there where I think the markets are not going to be as thriving. Or maybe I go the other way. Maybe I go into the markets that I think might have some upward slope to them but are not thriving right now, and I think I can do something about that. But I do that because I have some market assessment. And I don't go to these other areas that are more vibrant and already have lots of economic activity. Either one of those makes it very hard to think about how to construct a counterfactual that it really is the same. So that when I follow both over time, I really know that it's the loan that made the difference. And so this is why with Compartamos, what we've done is we worked with them to do a study that was designed very, very similarly to the study that Abhijit Banerjee presented on in the keynote yesterday with Spandana in India. So in the same exact process, there's neighborhoods or communities or slums in the case of Spandana that were identified and demarked. And there was, in our case, there was 250 of them. And then we randomly assigned these neighborhoods, or in rural areas, it was more like villages, to either be treatment or control, where Compartamos would go into the treatment area and not the control. Okay, so now let me get to some of the, whoops. Oh, sorry, I have microcredit also, for a long time, as many of us all know, received almost nothing but fanfare, including the 2006 Nobel Peace Prize to Muhammad Yunus and the Grameen Bank. But then recently it has received a lot of criticism. And part of it is that it's a byproduct of that recognition that, wow, this is actually profitable, let's make money. And then people who basically criticized whether too much money was being made, and if so, whether the priority of making money was leading banks to lend to people who maybe don't have profitable opportunities and are getting over indebted. And so this was basically the tension that was created, and like I said, we lacked really strong evidence on what the results were, what the right answer was. The studies that were out there typically show, on average, some evidence of impacts, but nothing transformational, not the tool to solve poverty problems. But one question we always wanted to know is how much of the kind of mediocre results might be a byproduct of a lot of heterogeneity. Some people being made worse off, some people being made better off. Okay, so let me show you the results of the first study and then the second study. So that's the kind of rough overview. So this first study is joint with Jonathan Zinman at Dartmouth. So the motivation for here is severalfold. From firms' perspective, this is just business research. I mean, this could have been done for private science. It is done for private science all the time by consumer product firms, consumer finance firms, just understanding their market and testing out where is our sweet spot in terms of profitability. For regulation, there's obvious issues that relate, for instance, to some of the work you heard yesterday by Javier about disclosure policy and how well do people actually understand interest rates. And if people have no understanding whatsoever interest rates, then if we see lowering of interest rates, it shouldn't matter at all. If they literally just don't understand them, then this won't matter. It means they're deciding on all sorts of other margins. The third goes back to this issue of sustainability and this push that we've seen in the policy space often to raise interest rates under the premise that people are inelastic, which turned out not to be true in this case. So the study design, we had 80 clusters of 132 branches that were right next to each other. We put into the same unit of randomization because we were concerned about how to really draw the boundary, and so that we didn't want confusion where people knew what their interest rate was and they didn't really, we didn't have to worry about their neighbor having some other interest rate. And half of them received a high rate and half of them received a low rate of 90% APR or 80% APR about. That does not include the VAT and the tax and the mandatory savings deposits. So the true APR to the client is a bit higher. One important design feature is that everybody's interest rate was reduced a little bit. So there was no promotion effect, so to speak. So if you thought that the high rate was the normal rate and then we dropped some to the lower, that maybe that people don't understand interest rates, they just get the idea that there's a promotion and they like that, and so they're happy. But it's not that they really are calibrating the interest rate and thinking about whether that's the price at which they want to borrow, and if so, how much. But everybody got a lower rate. It's just that the lower people got a rate that was that much lower. The other thing to note in terms of a promotion effect, which we were very concerned with in the design, was the study is a 3-year design. So I don't, we might have seen an initial drop from a promotion, but 3 years later we wouldn't still see increasing effects from a promotion 3 years earlier. So the study was conducted over the entire country. That's the blue and red, or treatment and control. So basically the bottom line results are, as I mentioned, highly, very elastic demand. We see increase in the number of clients brought in, new clients. We see an increase in the number of retained clients. We see an increase in the volume that people are borrowing, conditional on borrowing. So across the board, we see evidence of increase in revenue. Like I said in the intro, the increase in revenue is so big that it overcompensates for the loss of revenue from lowering the interest rate and ends up with a net positive impact on revenue. We do see this increasing over time as well. It grows. What's one of the unique things of this study was, because it's not a direct mail shot that was a one-time thing, it allows us to see, do competitors respond? And it allows people to really have the option to borrow when they need to, rather than just being what the immediate response would be from a marketing solicitation. We actually find very little heterogeneity. We don't have a lot to go on here, but we are able to look and see whether more educated people, for instance, maybe understand interest rates better and so are more sensitive. That's not the case. We don't find any differences across different types of people. So, bottom line is, we do see this big increase in outreach, but we see no change in delinquency. We see no change in profits because the costs go up. We also see no competitive response, interestingly, although I don't think that's actually that surprising in light of results like we heard about yesterday from Javier. We also do not see a reduction in borrowing elsewhere. So this is an important question from a policy perspective, from a macroeconomic policy. When we lower interest rates, if we're just seeing business being stole from one place to another, this has important implications for firms and how they're going to compete with others. But from a macro perspective, it doesn't mean that we've actually expanded usage of credit. But the evidence we see suggests that this does actually lead to an increase in the aggregate use of credit. Okay, but the bottom line is lowering rates expand access to credit without sacrificing profits. Who cares? Right? And so that's why the impact study. Is this good or bad? What do we think about this? Or are we just moving, is this something, just that? Is this something to then get excited about, that when you've expanded access to credit, we now have made the world a better place by giving people more options, or made a world a worse place by doing something that gets more people over-indebted? Hence the second related paper, and this paper is also with John Zinnemann and Manuela Angelucci from University of Michigan. So Compartamos is, frankly, a perfect partner for this because they have been a controversy for many years. So a quote from Carlos Danell, their CEO, who basically defends Compartamos by arguing, well, here's the quote: "A lot of people have suggested that financial inclusion can be a poverty alleviation tool. We're not out to prove that. We're out to provide financial services as opportunities to these clients, realizing that some people might make better use of them than others." So obviously that's phrased a little positive. We don't know what the point is, that that's acknowledging and saying, like, look, yes, we're not transforming people's lives radically, and some people will make better choices than others. And so then the question we want to know is, how much variation do we really see in there? And are the ones who are the not better than others, those others, are they actually worse off? Or is it just not changing lives? Compare that to Mohammed Yunus. When you discuss microcredit, don't bring Compartamos into it. Microcredit was created to fight the moneylender, not to become the moneylender. So, right, this is zooming in right on the interest rates and saying those interest rates are simply wrong, and nobody can possibly be made better off at that type of price. Obviously, there's a business case too. One thing that I often do think is very important to point out in this type of context is, yes, Compartamos' rates are high by international standards, but by Mexican standards, they're the same as the nonprofits. So it's not the challenge that we should be thinking about as policymakers, as lenders, is what's going on in Mexico and other countries that the rates are that high. What can be done to bring down the cost of operations? Because it's not the case that the for-profit model is actually charging higher rates than the nonprofit model when they operate side by side. Okay. So in this study, we had 238 clusters randomized into 128 treatment, 118 control. I think I said 250 earlier in case anybody was listening to the details. The 12 had to do with drug trafficking problems in some neighborhoods that neither Compartamos nor our surveyors wanted to go to. Okay, I'm down to a little bit of time, so I'm going to skip over the details of what Compartamos did, other than to say two things in terms of their lending product. It's a group lending model that uses groups to form the few identified leaders who then have to find groups. One important difference is that there is a kind of values component to the weekly meetings. The weekly meetings are not pure business. And of the 7 randomized trials that I'm aware of that have been done on microcredit, none of the other 6 lenders had any impact whatsoever on female power in the household, nor did the meetings and the process of lending do anything whatsoever beyond the pure business of lending. And this is the only one of the 7 that has some element beyond pure business in the meetings, and also likewise has an impact. One of the positive impacts we do observe is a positive impact on female power within the household. So let me get to the results. So we examined things across the board: credit use, business activity, income consumption, and other welfare. And the one important thing I want to note, and this is true of the Spondana study as well, is that the results are really at the community level, not the individual level. So this takes into account kind of displacement effects, you might call them, where, or spillovers, where maybe lending helps some people but hurts their competitor firm that's right next door to them, right? Because we're measuring the impact of the community. So as long as that spillover takes place within the boundaries of the unit of randomization, which is a decent-sized neighborhood, then this should be thought of as the impact of lending, of offering credit to the community as a whole, and that includes all those kind of general equilibrium effects that take place within the boundaries of the communities. So the basic results were, the first thing that's always important that is consistent across these studies is we do see always an increase in borrowing. That's actually a first order test, which is important to see. If you don't see that, it means that any credit market failure that may have existed wasn't on the extensive margin of giving people access who didn't otherwise have. It may mean you addressed a market failure by giving them better credit in some respect, in some term and condition that they preferred. But if they're just getting rid of some other loan and taking out this loan, it doesn't mean that they're lacking access to capital. It means they're lacking access to capital at a price or term and condition they like. But across the board, across Abhijit's studies, across my earlier study, we always see this first stage does take place where we are seeing increase in borrowing. So what decreased over here was a membership in informal savings, which is a bit of a substitution from if you're using informal savings to accumulate capital. And we also saw a reduction in asset purchases, interestingly. We also, with that, saw a reduction in, and it's over here on the right, fewer asset sales to pay off loans. And those two to go together, if you get access to a loan to pay down debt, you no longer have to sell an asset in order to pay down that debt. So it says that this is being used as a debt management tool. And so those two we think go together. But what you basically can see in the middle is no change in things that we would normally call poverty, right? No change in income, no change in consumption. We do see that businesses get bigger on the intensive margin. We don't see new business starts. So it's a little bit different than the Spondana results you saw yesterday. Rather than business starts, we see existing businesses grow, but not become more profitable. They just revenues and expenses both go up. We do see a lack of depression go up, so and trust in other people, right? That might be a byproduct of the group meeting process, and the household decision-making power that I mentioned. Now, the subgroup analysis is perhaps the most important thing, though, that I've wanted us to focus on. And so I'm not going to go through every detail given the timing, other than to say that we do find consistent results with prior business owners being consistent with the average results, as well as for those who are more educated. But we do see some pockets of negative results that are really important from a policy perspective and from Compartamos' perspective. The most important being those without prior formal credit experience. We see, hold on, how do I, oops. How do I get to this? I should be able to click on that detail thing, but I can't. Shoot. Okay. Well, I don't know how. I'm trying to click on that little detail button, which then shows you the details, but I'll skip it. Other than to say that the people without formal prior credit, we saw increases in some of the bad outcomes like stress and insatisfaction with their economic condition. Right, so this has a really important policy implication, right? If these, partly because this is a targetable group, right? It would be much harder if the identified subgroup, which was made worse off, was based on something that was coming out of our survey that was more touchy-feely, maybe important. Let's say we identified people who had less decision-making power in the household in the beginning. It turns out it doesn't work for them. It just helps strengthen the people who are already strong. Right? That would be a very hard policy implication to take to a bank and take to a policymaker, because you can't expect banks to screen on that and then differentially lend. But prior formal credit has actually really important immediate policy implications. And so, but the question, actually, let me back up. You can divide it into two things, and we can't say which one of it is. Is it the case that people without formal prior credit are simply the type of person who are not going to do well with a loan? in which case the policy implication is figure out how to don't lend to them, or the more optimistic view would be, no, it just means that the service needs to be different, that they need to have their hand held to figure out how to get them comfortable with the lending process, that they've never experienced it before. They were willing to embark in the process, but still scared by it. And in that process, when they did get access, they didn't cope well with it. And so that suggests that doing something slightly different for them might actually have a good byproduct of getting them more comfortable with the banking system and getting them integrated in. And that could have spillovers to other facets of their financial services life in terms of savings and insurance and things of this nature. And that there's a divide between those who are comfortable with institutions and not, and the people who are not are kind of brought in because of the on-the-ground aspect to this, because they're not having to come in because Compartamos does, like, the meetings are not held in the bank branch, and so there's a little bit of an informality to it. And so that gets them into the system, but it's still not something that they're fully comfortable with, and so when they get access, they are made worse off. And so that's an important question, and this is one of the things that we're now working on with Compartamos, or at least we're in the design phase talking with them about how to deal with this. And one potential solution is that this means that the type of training that they receive in the meetings needs to be focused in on how to get them more comfortable with banking services, to understand them, to plan out their repayments better, and in order so that the repayment of a loan is not something which causes stress to them. So hopefully in a couple of years we'll have results from those types of studies to share. Okay, so the basic conclusion, to put the two together, is that we start off with this interest rate study. We find that lowering the interest rate does actually bring in a lot more clients, huge sensitivities. And then the second paper basically says, okay, and what's the impact of this? Well, it's on average good. It's on average mediocre, I think, but I think from a double bottom line perspective, that's actually good. When you think about what could possibly happen from borrowing at 80 to 90% to 100% a year, right? This is not going to be the story of someone who was turning around and investing at 200% on average, right? That can't possibly be what the average population is. So seeing that average benefits do go up and depression goes down and female power goes down, given the terms and given the market, is actually a ringing endorsement to a kind of a double bottom line. Having said that, it does also highlight that the results are not the same for everybody. And we need to pay attention to that, and we need to understand that it's not just about average impacts. If we as policymakers are going to encourage micro-lending and for-profit models for micro-lending, we do have to understand how to figure out who's made better off and who's made worse off, and how to set the right policies to focus on providing the right service to the right people. So I'll close with that, and thank you very much, everyone.
So anyways, continuing on with Dean's results. I didn't have the pleasure of actually being involved in the entire study, but I wanted to just touch on that it was a long journey. I think it was a very interesting and a very interesting exercise for us at Compartamos in many respects. Most importantly, I think the reason we went behind this study and we decided to do it is to kind of shed light a little bit about this important debate about how to better serve our customer. And I think that's something that all of us have today. How can we better serve our customer in the best way possible? And I think we wanted to really push the envelope a little bit more on how to do that. And I think when you look at a lot of the market studies today, and ones we've done before, focus groups, surveys, you do a traditional approach where you do try to see what are the customer's needs and then try to adapt the products and services to those needs. And what's interesting, I think, with a lot of these RCTs is that it really kind of tries to understand how the credit really weaves its way into the lives of our customers. How it influences the decisions they make. How does it influence how they live their lives within their family, within making decisions with their husband, within investing in their business, within investing in consumption or not consumption. So I think a lot of these factors were really, we could see them kind of play itself out in these kinds of studies. With other traditional market studies, I think a lot of us are accustomed to, we couldn't see. And so anyway, putting that further, let's see. So what did we learn?